afternoon, Ian.
Good afternoon, Simon. How are you?
Very well, thank you. Very well indeed.
Good. Excited to be here for us to have another fireside chat and basically just talk about questions that we get asked by clients, prospective clients, friends and family, but actually record it for the benefit of our listeners.
Indeed. And the question we're going to look at today is, how do I take an income from my pension or portfolio of investments?
Yeah, that's a good one. It's a popular one and it's a really important one, Simon.
Yeah, it is indeed. Now,
Do you want to kick off by sort of just talking to us a little bit about our thinking as a firm and as individual planners as well?
Well, it is. I would say there were a couple of points, and possibly the point the person who asked us was making was that if I'm taking an income from an investment, am I limited to taking the natural income? So in other words, if I've got shares, are we limited to dividends? If it's cash in the bank, are we limited to interest?
Always a really interesting question to answer, because you're absolutely right, Simon. There are a lot of things that go on in an investment portfolio, for example, that sometimes clients aren't really mindful of, because nowadays investment portfolios can come very nicely wrapped in one account with maybe a couple of funds, right?
Yeah.
So clients need to be mindful of all sorts of things, like, for example, interest that bonds might generate, dividends that shares might generate, but also those same shares might actually grow in value, so the capital gains along those. There's many component parts, but why don't we break it down and just try to go through those different parts and perhaps how clients can think about their retirement income planning? Absolutely.
One thing I think we should cover off before going into this is, if we're talking about a pension, then traditionally what lots of people would do was to buy an annuity. An annuity is absolutely the right thing to do for certain people in certain circumstances. An annuity is simply, as you know, swapping a pension investment for a guaranteed lifetime risk-free investment. But it's not suitable for everybody, and it's not suitable every time. And so what we're going to do at the moment is to ignore annuitization, and we're going to simply say, if you have an investment, how can you best what are the options of taking an income out of it? So I'll just share my screen and we'll go straight into a very short presentation. Now, can you see that okay, Mia?
Absolutely, yeah.
Okay, so as you know, we've got the three buckets planning sketch, as we call it. Now, in financial services, I think a more official title would be Cascade Cash Flow Management. We tend to call it three buckets for reasons that I think will become fairly self-evident. So, shall I do a bit of narration, or would you like to?
Yeah, please, crack on.
Okay. If we're looking at the long term, we're talking sort of generalizations at this point in time, but as you can see, we've got a blue line and we've got a green line. And over the long term, as I'm pointing to here, we're talking some sort of 5 to 30 years. And as a general trend, it's fair to say that inflation rises each year by more than cash in the bank. Would you agree with that?
Absolutely, Simon. And that's what visually we're trying to represent with this graph here for the folks watching. It's all well and good having £1 or £2 or £1 million in the bank. But the problem is, as the years go by, the purchasing power of that £1 or that £1 million becomes lower and lower. Because what that green line is showing you is that the things you can buy with that said £1 are getting more and more expensive over time.
Absolutely. Now, and again, it's worth stressing that at the moment we're just talking about my back of a serviette diagram here, but if we invest into bond funds, and by bond funds we mean, wrong direction, we're talking about corporate and government debt. As we can see here from my line, there's more volatility involved, and by that we mean the funds increase and decrease more, but in the long run, they are outperforming both inflation and cash.
Absolutely. And, traditionally, Simon, and this is just a bit of a sort of a techie insight for our listeners, but those annuities that Simon was talking about a few minutes ago, they would have been underpinned by bonds. In other words, it would have been a basket of bonds that would have been generating the interest necessary for an insurance company to be able to sell you an annuity. So sell you a guaranteed income for life in exchange for your pocket money.
Now, if we introduce one other investment category, which shares in companies, as you can see, lots more volatility, but equally lots more growth. Now, what we're actually doing is dividing the investment horizon into three terms. The short term, years 1 and 2, medium term, 3 and 4, and for the long term, we're assuming 5 to 30 years plus. And what we're suggesting is that in the short term, if you just retired and you were needing an income, if you were needing to take money out of the investment and you're in equities, wouldn't it be unfortunate if you chose this particular time here? Now, this, as we know, is something called sequencing risk. It can be just unfortunate timing. But for the short term, folks should have money in hard cash. Why hard cash? Because cash is, well, the advantage of cash is it's positively boring. It doesn't go down in value. And in the short term, we like boring. We're not hedging against inflation. We're simply wanting an investment that does not drop in value. In the medium term, we can have anything that just about hedges against inflation. If you've got really good eyesight, that says RPI, CPI on the side of it. But if the client has index-linked national savings certificates, or if they've got some bonds, it's anything that just about hedges with inflation. And finally, we've got the longer-term portfolio. And of course, what we're talking about there is a balanced portfolio that's made up of a whole basket of equities, global equities and bonds. And this is designed to be left alone to grow for the long term.
I think that's a brilliant point, Simon. And again, for our listeners who perhaps are thinking about their own calibration of their own buckets, just the way things stand at the moment, if they were to build their own sort of assets and liabilities sheet, you can imagine that a lot of clients choose to retire at a point. In fact, I'd say the majority of people choose to retire at a point without knowing what the future has to hold. I mean, Simon, our clients who we met and worked with throughout last year and happened to retire in November, December, and had all of these plans for 2020, it, by no fault of their own, nothing that could be imaginable, let alone predictable, completely derailed those plans. However, it did not derail their financial plan. Because by having these three buckets calibrated this way, that big bucket you're seeing on the screen now, yes, that might have gone down because of the economic crisis we found ourselves in due to the coronavirus pandemic, for example. But their short-term bucket, the money they needed to leave at the till at Sainsbury's to continue maintaining just the same lifestyle they've been used to up until that point, well, that was in, as Simon said, boring cash. And boring cash, when needed, is king. So really important to think about not only, do I feel equities or stocks or the stock market, do I feel that's risky or not? That's one question. But the other question is, can I build the financial plan so that it feels less risky to hold an investment portfolio for the long term, because I know that I'm calibrating my short and medium term buckets accordingly?
Exactly. We're matching their liabilities. So the things we've identified in their financial plan, and we're matching investments to meet those liabilities. Those liabilities can be anything from the Waitrose or Sainsbury's bill to their holiday or whatever it could be. So this is clearly just my back of a serviette diagram, but let's just look back in time for a moment. Let's just take a bit of a history lesson and go back to the global financial crisis and the 10 years that ran after that. So what we're looking at here are in essence the same asset classes as we've looked at the previous slide. Down at the bottom, F is a proxy for cash. E, second line from the bottom, is inflation. We then have a short-dated bond fund, third from the bottom. And then we have a mixture of one of our middle-of-the-road portfolios, and then a world equity index and a UK equity index. Now, clearly, if we look over 10 years, and with the benefit of hindsight, equities are the place to be. But let's just focus down for a moment to the very start. And this is where you've just retired. And then let's focus in properly and say, if you'd been in the markets, if you'd been in this grey FTSE All Share, if you needed the money for whatever reason, then all of a sudden we're looking temporarily at a 35% loss. And this is what we're trying to guard against, a distressed sale at any point in time.
And you know what, Simon, it's interesting how by no means we're saying that history repeats itself, but what we're saying is by becoming a student of financial history, you get to start appreciating the fact that there are patterns that emerge. And a pattern here, clients would have seen pretty much what you're showing on screen there repeated in March and April this year. The only difference is the cause was completely different, and the violence of the drop and the violence of the sort of recovery of the market was probably sharper. But nonetheless, what you've shown there, Simon, leads us to probably the most important point, and where we think as financial planners we can add a lot of value, which is the primary determinant of a successful investment strategy isn't necessarily the esoteric or the best or the hot funds that you have underneath that investment strategy. It's one's behavior with one's investment strategy.
Indeed, yes. Absolutely. So this leads us really back onto the buckets on our favourite slide, Absolutely. Which summarizes how we consider investments should be designed. So in the short term, our principal concern is volatility. We are relatively relaxed about inflation. So your requirements from cash are matched, and there you go, there's a tap on the side, and you can drip out whatever you should require. Now, the simple principle goes as follows, which is in a rising market, you spend 12 months of cash. And so we meet up for our annual review. And at that point in time, we're simply taking a year's worth of money from the rising portfolio, and we cascade it down all the way to cash. And we repeat this process every year, always making sure that you've got 2 years of cash, buffer for RPI for another 2 years, and the portfolio thereafter. When the markets, however, go south, and they do on a pretty regular basis, and as you remember, Amir, I've been doing this now since 1986, so I've worked my way through quite a few financial crises, then what this allows us to do is to say to the client, there's no need to panic. You have 2 years of cash, 2 years of inflation protection bonds over here, and that's before we have to go anywhere close to the portfolio. And statistically, more often than not, the portfolio has staged, if not a full, certainly a pretty decent recovery at that point in time.
Absolutely. And for the folks listening to this that are not familiar with this concept, I want to use a word that, we at our firm use a lot, which is this business of creating peace of mind with your financial plan. Our clients, they enjoy peace of mind when they work with us because of these financial planning frameworks that we have in place, not because we are the best of picking some sort of outperforming fund, because frankly, that isn't a discipline that neither we nor the listeners should be interested in. They should be more interested in having a financial plan, having these buckets calibrated in a way that gives them peace of mind, so that they know that their long-term investment bucket is their long-term investment bucket, and they never need to access that in a panic. And I think this, Simon, just illustrates that in a really simple way. How much peace of mind would the listeners to this webinar have if they just had structured and calibrated their financial life along the lines of these three buckets?
Absolutely. And nobody has a crystal ball, despite what they may tell you. Nobody has a crystal ball, and we're not trying to predict the future. We're saying let's build certainty in, let's build peace of mind in. Now, the one other thing we could lead, that naturally leads on to, is the amount that you can securely take out of your portfolio. That's a subject I think we should tackle on another day, Amir.
Absolutely, Simon. I think you're absolutely right. We'll definitely leave that for another video. I know a lot of our listeners are curious about these sort of topics. There are rules of thumb that get quoted in the press around percentages that are safe withdrawal rates. We'll definitely tackle that one in a different video. And in the meantime, of course, if any of our listeners here have any other questions that are important to them, fire them to either Simon or myself, and we'll make sure that we cover them eventually in these videos too.
We'd be delighted to. Thank you, Amir. Speak to you again. Have a good afternoon.
Simon, thank you.
Bye.